Owning mostly your employer's stock in your retirement account means a scandal at the company can slash your savings at the same time your paycheck stops. People tell themselves they are loyal, they know the business, and the match stock is a free boost, so they overweight the familiar and skip the rest. Your entire future becomes tied to the fate of that firm and its niche, so a bad headline can hit your job, your shares, and your local housing market together. Picture checking your account on a calm afternoon, seeing green across different tickers, and not realizing they're all writing the same story that can turn on you without warning. Diversification is the discipline of spreading your money across different drivers of return so that the same piece of news does not move every part of your portfolio the same way. It is not a pile of accounts or a stack of product names. It is exposure to varied businesses, sectors, geographies, and asset types that are affected by different risks. The goal is simple. Limit the damage from what you cannot predict by refusing to let any one risk dominate everything you own. When one area struggles, others either hold steady or help, keeping your plan intact. Here's what this looks like in real life. A coworker loads up on his employer's shares because he believes in the mission and sees the discount as easy money. He buys a popular fund that also holds that company and grabs an industry fund for extra punch. On paper, he owns 3 things. In reality, he owns the same story 3 times, and when that story cracks, his job and portfolio fall together. The most common beginner mistake with diversification is counting tickers instead of risks. People think 3 funds equals 3 uncorrelated bets, so they chase a big brand index, a trendy sector fund, and a broker's featured pick. Under the hood, the top holdings repeat, and the sector exposure stacks up in the same place. The labels look different, but the engine is the same. That is how a portfolio that looks busy still behaves like one concentrated bet. If any holding or theme is more than a quarter of what you own, you are not diversified. That kind of weight means your results rise or fall with a narrow outcome. You may feel smart while it is winning, but you have simply swapped uncertainty for fragility. You have made your success depend on a small set of variables behaving exactly as you hope. That is not strategy. That is exposure you cannot afford to be wrong about. Concentration costs show up when the world refuses to match your story. A supplier fails, a regulation shifts, a leader leaves, or a trend just cools off. And you are forced to watch the same damage hit every corner of your portfolio at the same time. You stop thinking long-term and start reacting to noise because the swings are too large to ignore. You sell good assets just to plug holes. That is the bill coming due for letting one narrative control your net worth. The correction is straightforward. Audit what you own, not by ticker count, but by the forces that move each holding. Group your investments by sector, region, currency, and for bonds, by credit quality and interest rate sensitivity. Pull the fund fact sheets and look at the top positions for overlap. If the same names appear again and again, you are not diversified, no matter what those fund titles suggest. Next, think in layers. There is the business layer, which is stocks across sectors and countries. There is the lender layer, which is bonds of different quality and duration. There is the real asset layer, like listed property and infrastructure, which earn from rents, tolls, and contracted revenues. Each layer responds to economic news differently. Your job is to decide how much of each layer makes sense for your goals, and then implement it simply. Diversifying across stocks and high-quality bonds has often trimmed the depth of equity sell-offs by about 1/3 in rough markets. Bonds do not always go up when stocks go down, and nothing is guaranteed in every scenario. But they are driven by different mechanics, so they rarely fail for the same reason on the same day. That gives you options when others are trapped. Options are what keep a plan intact when headlines get loud. Correlation is not fixed, so you do not build a portfolio expecting perfect offsets. You build it expecting variety in what drives returns. Energy prices, interest rates, consumer demand, currency moves, and policy surprises shift the ground under assets in different ways. Sometimes they line up and move together. Other times they pull apart. Diversification accepts that you cannot predict those shifts and prepares you to stay on track through them. Another beginner mistake is diversifying by brand, platform, or advisor. People open accounts at multiple brokers, chase a few influencer picks, and add a robo-finish on top. They think spread out equals spread risk. In reality, they have duplicated the same exposures and added friction. Extra complexity does not reduce risk, it just hides it until it matters. The cost of that mistake is measurable. You pay repeated fees for overlapping funds that all hold the same giants at the top. You create tax messes when one app rebalances into gains while another app sells the same names at a loss inside a taxable account, wasting offsets and creating wash sale headaches. Worst of all, when the tide goes out, your accounts all move down together and you have no dry powder because you spent it chasing the same trend in different wrappers. Complexity turned into paralysis right when action was needed. Set rules that force balance. Cap exposures so nothing dominates, and so your results do not depend on one sector, country, or theme going perfectly. Decide how you will add money each month and where it will go before markets move. Use the plan to direct contributions toward the parts that have lagged and make sales from parts that have run too far. The rules protect you from your own enthusiasm and your own fear. Set a ceiling so no sector or country exceeds 10% of your total holdings. That keeps any single story from dictating your outcome. If something grows past the line, trim it back and send the proceeds to what is underweight. If a new idea would push you over the line, fund it by cutting a similar risk elsewhere. Constraints keep the whole portfolio healthy instead of letting a winner turn into a liability. Rebalancing is where diversification earns its keep. You are not predicting, you are restoring balance. Pick a simple schedule and stick to it. Add to what is down and take from what is up, without drama and without waiting for confirmation from headlines. Over time, that mechanical trade against recent moves turns volatility into a source of return instead of a source of stress. Chasing the latest winner is the oldest enemy of diversification. Momentum stories look obvious in hindsight, so people rush in after a big run and tell themselves they are spreading bets by adding another fund with a fresh label. Then the wind shifts, and that shiny theme falls 30% while the rest of their picks follow because they were all exposed to the same engine. Buying high and watching a crowd exit at the same time is not bad luck. It is a structure that guaranteed pain. Diversification would have limited the damage and given you something else to own while that story cooled. Also look at where each asset sits. Tax shelters are a good home for income-heavy bonds and real estate funds, while broad stock funds can do fine in taxable accounts where the taxes come mostly from dividends. Do not mirror the same holdings in every account just to make the screens look tidy. Spread the roles across accounts to serve the whole plan. And if your employer offers discounted company stock, keep the allocation small because your paycheck already lives in that risk. Diversification is not about building a museum of products. It is about reducing the chance that a single surprise forces you into a bad decision. You want a structure that lets you keep saving, keep rebalancing, and keep ignoring noise because no single headline can wreck everything at once. That is the shift. Stop treating investing like a search for the perfect pick and start treating it like building a system that survives many different futures. Next, in how the stock market actually makes you money, you will see why the right mix of assets compounds quietly while you get on with your life.